Bearish breakout unfolds. The SPX is eyeing 5,610. So the Santa rally appears to have officially left the building this year. The January effect is the last glimmer of bullish hope, and it is tripping over itself at the moment as a bearish move evolves. And historically, if we do continue to see a bearish January, this can mean a more challenging year ahead. But for now, let's dive into how we're going to trade this over the next few days. So when Santa fails to rally the market, and even the January effect is failing to prop up any bullish movements in this market for the moment, there's a well-known adage starts to ring true. If Santa Claus should fail to call, the bears may come to Broadham Wall. And ultimately, it's just a phenomenon that we see at this time of year. If there is a bearish sentiment over the beginning of the end of December, beginning of January, and through most of January, again, it typically suggests a pretty poor year ahead for the market. So we could ultimately see some bearish market movements. Now, for the moment, what are we going to do in the short term? What we've seen is the double bottom that we commented on previously turned into what could have been a descending triangle, which is what we noted in the blog when we were writing up this. That turned into a triple bottom. And one of the things that I commented on, and this is the thing that's never mentioned in any of the textbooks, it's the evolution of price action, these price patterns. Just because you see at the time a double bottom with new information, don't be afraid to change your minds. You know, these patterns evolve and change and mutate. So it's very important to say, okay, well, now it looks like a double bottom. When this lower high started to develop, it was looking like a triangle type pattern, which is a type of consolidation. And obviously now we know, with a little bit of extra information, we've got this flat base. We can start to label it again and call it in this case, a descending triangle. Now that descending triangle on the 30-minute charts, if we look at the daily chart at the top left, it's part of a larger pattern which was causing a little bit of directional conflict when we first spotted what was initially the double bottom. But that right shoulder is this triangle pattern. We've seen price push through the what was traditionally called the neckline on that pattern, which is the breakout of the right shoulder. Both have a target down towards 5,600, 5,610 for a bearish move. The overnight futures are already off 50 or so points, so we should be gapping lower. I would imagine we'd see a little bit of a rally, just retest maybe the 5,800 and then start that bearish charge to the downside again. Target 1, 5,700, target 2, 5,610 is what I'm looking at. Again, with Friday's trigger through the bear breakout and the bear hedge trigger, I've now got some bearish positions on. Finally managed to get some bearish exposure in this market, so we should start to see some profits come good as we see the downside movements unfold. What I'll be looking to do, assuming that we get some follow through, is see if we can compound into this bearish movements as we trundle our way down to the targets and see if we can maximize the profit opportunity. If you like what you've heard here today and want to learn a specific entry, exits and trade management method that I use to profit in the SPX options markets, then click the link next to this video and you'll be taken to a free training where I describe one of my favorite money making patterns. So if you click the link, I will see you over there.